Good evening, friends. Welcome to the session. I would just like to add few more points here. We had a great session earlier on ODI, so we'll just be taking some time of yours and adding few more provisions to it, and then I'll just be telling you the main legal part of ODI for a few points, and then sir will be sharing his rich experience onto those topics. Topic here is overseas direct investment. We have heard a lot from the earlier speakers. We'll be covering few points here specifically. So we have actually seen the significant changes in overseas investment with respect to the 2022 regulations, rules and directions, which broadly provided for enhanced clarity of definitions. The concepts were redefined, concepts of foreign entity, Indian entity, the control, and the concepts where pricing guidelines were provided. There were NOC concept from the lender, regulatory body, investigating agencies introduced. They were dispensing with the requirements of approvals required for deferred payment considerations. Then there were investments or disinvestments in the NOC point that we just said. There are many more things like clarification for round tripping and many more concepts that were added in these regulations. So a little recap of for permission for making overseas investment. There was this automatic route, and then there is this approval route. Automatic route where permissions are given to a person resident in India to make or transfer any investment or foreign commitment outside India. Just the foreign entity need to be engaged in a bona fide business activity. An investment can be made directly in the foreign entity or through SDS or SPV, as we just saw. Quite great examples shared right now. So Indian entity, resident individual just need to make application in Form FC, giving the details therein. They need to attach the required documents, approach the AD bank for making investments. In case foreign investment is through approval route, they have to approach the AD bank. AD bank will conduct proper scrutiny. They'll give specific recommendations, which will be used by the applicant and later on with the RBI. The AD bank will submit this Form FC and OID, on overseas investment, this form application to RBI with its recommendation. The approval route here is divided into two parts. The one is with the approval that is required by the central government, and one where we need the approval of Reserve Bank. So broadly, in approval route we will be requiring to file Form FC. The background and brief details of the transaction is to be given. The provisions under which the approval sought is to be marked in that form. The AD bank will make observations on prima facie viability of that foreign entity. It just needs to understand that nothing illegal is being conducted. So they'll do their basic homework. Prima facie viability of foreign entity will be seen. Benefits which may accrue to India, the Indian entity, will be seen. The financial position and business track record of Indian entity and foreign entity would be considered by the AD bank. And any other material aspect that the AD bank will consider necessary to see that whether this particular overseas investment is genuine, bona fide, and it's not causing any illegal activity. The board of directors will approve the investment if this is an entity. The Indian entity corporate structure, including the step-down subsidiary with operation details, would be looked into. Valuation certificate for foreign entity would be needing in case if it is an existing company acquisition. And other documents relevant for the proposed investment will be required. Central government approval, when is it required? It's required in the case where we are making a person resident in India is making an investment or financial commitment in Pakistan or any other jurisdiction where the any other jurisdiction as prescribed by central government. Or if it makes investment or financial commitment in strategic sector, however, above the permissible limits. And investment and financial commitment in other specified geographies as specified by the central government, again above the permissible limits. For that, we need central government approval. So typically the process would be the applicant would go to the AD bank. The AD bank will make the necessary arrangements, will do the above task that's written. They'll forward this application to RBI, and RBI will consider the case and forward it onward to the central government. Where we would require Reserve Bank approval is whenever a financial commitment is made of US dollar 1 billion or more in a financial year, even though the total financial commitment of the Indian entity is within the limits under automatic route. In that case, we would need Reserve Bank approval, and the procedure would be the same. The applicant would submit the application to the AD Bank and then to the RBI. Now, specifically, we'll be dealing here with few topics. The first one being the no objection certificate from the lender or lender bank, regulatory body, investigating agency. So, primarily, a person resident in India making financial commitment or undertaking disinvestment. Here, disinvestment means partial or full extinguishment of the right, title, or ownership of the equity capital acquired as overseas investment. So, whenever any investment or financial commitment, as we know, would be undertaken or disinvestment is undertaken thereof, we would, and these are the scenarios where the person resident in India either falls in these four categories. One, his account has been classified as a non-performing asset. Now, if we see what is a non-performing asset, it's a loan or advance for which the principal or interest payment has remained overdue for a period of 90 days. So, RBI says this is a non-performing asset. There, of course, thereafter that's substandard and doubtful and loss assets, but for us it's NPA. Or the person has been declared a willful defaulter. So the RBI gives 4 criteria for a person to be declared as willful defaulter. Those being broadly the units which have like defaulted in meeting in their payments or repayment schedules to the lender, whereas that PRI has had the capacity to honor those obligations. This being the first, the basic one. The second being units defaulted. They haven't utilized the finance from the lender for specific purposes for which it was taken, for which the finance was availed, and diverted the funds for other purposes. The third being units have defaulted in repayment. They have siphoned off the funds so that the funds have not been utilized for specific purpose for which finance was availed. Plus, the funds are not available with the unit in the form of other assets. The last being for willful defaulter, that they have defaulted in payment repayment, but they have disposed of or removed the movable fixed assets or immovable property given for the purpose of security for a term loan without the knowledge of the bank or lender. These are broadly the criteria for being declared as a willful defaulter. Of course, the RBI provides for a detailed provisions and criteria which will fall under these 4 categories, which will make a person willful defaulter. So, the account of the PRI is non-performing asset. 2, the PRI is a willful defaulter. Third, if there is any investigation going against that person resident in India by a financial sector regulator, that being SEBI, RBI, RIDA. And fourthly, that any investigation is going on against that person resident in India by any investigating agency, those being CBI, ED and SFIO. So these are the 4 criteria where a person resident in India would be really needing an NOC from the lender bank, regulatory body and investigating agency. So of course, they'll be needing an NOC from lender bank if they have been classified as NPA or willful defaulter. They will be needing the NOC from the financial sector regulator if they are undergoing any investigation by a financial sector regulator. And they'll be needing an NOC from the respective investigating agency if there has been an investigation against them initiated by CBI, ED or SFIO. If the concerned authority fails to furnish NOC within 60 days from the date of receipt of the application for such NOC, then it will be a deemed NOC from that concerned authority's side. So they have to answer back in 60 days. So NOC is to be addressed to the AD bank and endorsement to the application. This is the basic procedure. However, no NOC is required where Indian entity issued guarantee. But there's a criteria. The Indian entity must have issued that guarantee before the investigation had begun or the account being classified as NPA or willful defaulter. So if the Indian entity issued guarantee before that stage and now they are required to honor that guarantee and it's being invoked now, then such remittance will not constitute fresh financial commitment. So now if it is not fresh financial commitment, they will not be requiring that NOC. So these are the two cases where, rather one case where you would not need that NOC.
Because investigation will continue, will never end. That is the system we have seen. Once a PMLA or ED or any investigation starts, a notice comes, investigation where you don't know whether it is finishing, whether it is continuing. Even for 3 years, no notice has come. But unless they close it, they will never close it. So that's why I think this is thing has come just to facilitate trade.
Right, and it's really difficult to understand how much in numbers they would be really getting this NOC, because once the investigation starts by the financial sector regulator or the investigating agency, these generally take a lot of time, and to prove the PRI being innocent and not done whatever is against him, put up against him. So that might take a long time, and we really will see in time how much this will work.
I think that's why the 60 days limit is there,
Yes,
because
60
they
days.
normally will not respond. You write a letter to CBI, will they respond in 60 days? They will not.
Or rather, they may say no to that.
No, भी कहने के लिए 60 दिन में action लेना पड़ेगा,
Yeah.
which is not that easy for any
Not that
person,
easy.
even with ED or anybody. So I think all likelihood, unless there is some very grave circumstances, they will quickly jump and say no. Otherwise, my feel is in 75% cases, no replies will come, and then you can go ahead and make the investment.
Right. So the next topic that we'll touch upon is rights issue and bonus shares. So rights issue of shares, any person resident in India who acquired and continues to hold equity capital of foreign entity, this being the basic investment, foreign commitment, they may invest further in equity capital as rights issue. And the only requirement is acquisition must be reported in Form FC. So they are allowed to exercise this rights issue option, and then they can acquire more shares. They rather may renounce such rights in favor of a person resident in India or person resident outside India. Just in case if they do not want to continue with they do not want to take upon the rights issue, they may renounce it, and they can do it in favor of PRI and PROI. And for this, no reporting requirement is there. For bonus issue of shares, any person resident in India who acquired and continues to hold equity capital of foreign entity may be granted bonus shares. So because it is not treated as a fresh or additional foreign commitment, it is not requiring any reporting here. So broadly, rights issue, of course, a PRI can exercise that option or renounce that option, and bonus issues, they can, of course, avail the bonus shares. And no requirement of reporting is here. Only in case if they exercise the rights issue, then Form FC is to be filled. Acquisition of a foreign entity through bidding or tender procedure. Nowadays, we see that there are a lot of bidding and tender being put up by the foreign entities. So if a person resident in India really wants to acquire a foreign entity through bidding or tender, so what can they do? So person resident in India who is eligible to make ODI, the first condition being they shall be eligible to make ODI, they may approach the AD bank once they have chosen the entity for which they are bidding or putting up the tender. They may approach the AD bank. They may ask the AD bank to make remittance for earnest money deposit, that being the money required by the company who is putting up the tender. Form A2 is to be filed before making this remittance. They may, alternatively, a bid bond guarantee may be asked. So the applicant, PRI, may obtain a bid bond guarantee from the AD bank for participation in the bidding and tender procedure. If it is open-ended bid bond guarantee, then it is required to be converted into close-ended within 3 months from the date of award of contract, if the contract is awarded. And now there are two criteria. You went for the bid or tender. Now, if you are unsuccessful, then the applicant person resident in India is required to repatriate that earnest money deposit as per realization, repatriation and surrender of foreign exchange regulations. That broadly says कि either you sell off the foreign currency through the foreign exchange provisions, मतलब you have to abide by the FEMA provisions. For that, you can sell off that foreign exchange, or you can actually hold those in the accounts that are allowed under FEMA to be held, or you can actually use that amount to service any debt or obligation that you have outside India. So for the permissible options, you can, of course, under these regulations, use that amount which is given as earnest money deposit. But if you are successful, and now you will be required to put up the additional remittance, so of course you can permitted to give the additional remittance. The reporting is done in Form FC. Only that reporting is required. If the investor do not wish to proceed, then the AD bank has to see whether the transaction was bona fide or not, and that earnest money deposit will be forfeited, or that bid bond guarantee would be invoked. And this is when the PRI doesn't want to proceed with that option. Now we will see ODI in startups. So this is new provision in this particular 2020 rules regulations. So ODI in startups is permitted if those startups are recognized under laws of host country or host jurisdiction. Just as they are recognized here in DPIIT, those host country or host jurisdiction should be recognizing those startups. The investment can be made by an Indian entity only from the internal accruals, whether from the Indian entity or group or associate companies in India. Internal accruals, again, that we understand the earning by the operations of the company, or like the profit that's they earn. So it should be only from the internal accruals, whether from the Indian entity or group or associate companies in India. However, in case of resident individuals, it should be done, the investment should be done only from own funds of such an individual. It shall not be borrowed funds from others. So this is the criteria required for an investment in ODI in startups. Prior certificate in this regard from statutory auditors and chartered accountants of the Indian entity investor, statutory auditors for the entity, chartered accountants for the investor, they would be needed. This prior certificate would be needed even to undertake this thing. That it should be showing that this is a genuine transaction. It's not borrowed funds, it's either the own funds of the individual or the internal accruals of the entity or group company. So the mode of payment, how a person resident can in India making overseas investment may make payment. These are the options. They can make payment by remittance through banking channels, Indian entities foreign currency account abroad. Swap of securities can be done. Valuation by a merchant banker is required in that case. Earlier it was, I guess, swap of shares. Now it's swap of securities. No payment to third parties on behalf of foreign entity except as foreign commitment permitted by RBI. So the person resident in India cannot make payment to third parties on behalf of foreign entity. It has to be by way of foreign commitment. Remittance only towards foreign financial commitment, equity or debt or non-fund based commitments and disinvestment. Nepal, Bhutan, in case of Nepal, Bhutan, dues receivable on for financial commitment made in freely convertible currencies, and sale and winding up proceeds required to be repatriated to India in freely convertible currency only. Like for ODI or financial commitment by way of debt. For this, there is a special provision like proceeds of ADR and GDR or stock swap of such receipts or ECBs raised can be used for payment of these. This is an exception given to ODI or FC by way of debt. No remittance to branch office or project office outside India for overseas investment allowed. No remittance can be given to them. Only what is allowed is for the purpose of normal business operations of such branch or office. And overseas investment by way of cash is not permitted.
So the basic thing is when you remit money, you cannot remit money through your branch office. Your branch office has money that you can't utilize when making overseas investment. That is the basic objective. You have to send it directly from India.
Directly. So next would be acquisition or transfer by way of deferred payment. So this is another mode of investment. Payment of consideration for equity capital acquired may be deferred for definite period from the date of agreement. Of course, there needs to be a definite period, and that definite period needs to be provided in the agreement. There should be a proper executed agreement or arrangement by way of which this has to be undertaken. So a person resident in India acquires equity capital from person resident and outside India by way of subscription to an issue or purchase from the person resident outside India. So there are two modes by which a person resident in India can acquire equity capital from person resident outside India. Those being, subscription to an issue. By that PROI or purchase from that PROI. Similarly, a person resident outside India can acquire equity capital from a person resident in India, and such equity capital would be reckoned as ODI. That is provided in the regulations. The conditions to be met for this is that the foreign securities shall be equal to the total consideration to be transferred or issued upfront by the seller to buyer. So the total consideration that should be equal to the foreign securities being issued shall be transferred or issued upfront by seller to the buyer, this being the first condition. Full consideration finally paid shall be compliant with the pricing guidelines. And such deferred part to be treated as non-fund based commitment. Because this is a prior arrangement that the parties have entered into, this would be a non-fund based commitment. Buyer may be indemnified by the seller up to the amount and in such manner as agreed between them. Maybe for that deferred payment, they may be entering into an indemnification clause provision. So they may, as agreed between them, they may be entering into this arrangement. In this situation, the AD bank has to verify that the agreement, proper agreement, duly executed agreement has been entered into. The transaction is bona fide as earlier the speaker told it should be bona fide for both the countries, both the whole Indian country and the host country. Related documents are to be seen and filed. Period of deferment is defined upfront. This is the criteria which we told earlier also. ODI through subscription remittance period defined upfront or on before acquisition setting up of foreign entity. If it is not, the ODI is not done within, the remittance is not done upfront, it shall be done on or before the acquisition or setting up of the foreign entity. It has to be reported in Form FC. It will be shown there as conversion of non-fund based FC to equity. And the valuation shall be according to the pricing guidelines provided therein. So this is overseas investment by resident individual. So broadly, resident individual are permitted to make overseas direct investment. Schedule 3 of overseas investment rules provide the details to be followed. The resident individual, single or in association with other resident Indian or Indian entity, may make this investment. The ceiling of LRS to be followed here is resident individual having control in foreign entity. If this is the situation,